Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. While there has been a few positive developments when it comes to the US debt ceiling discussion, the other narrative that has been slowly playing out is the underlying strength of the US economy. Both the Q1 GDP and the jobless claims were better than expectations. Let's look at the other side of the Atlantic. German GDP shrunk by 0.3% in the first quarter of this year, which is followed by a shrink in the fourth quarter of 2022, putting the country into a technical recession. Why are these important? Because currencies are all relative. The Fed doesn't need to raise rates to outhawk the rest of the central banks. It can do so even with a pause, because by pausing for longer than, let's say, ECB or BOE, it can still cause a rise in dollar strength. JK, good morning. I would like to know your thoughts. Clearly, I see a shift in commentary even by ECB members from being outright hawkish to now being data dependent. What's your take on this?
Uh, Good morning, Swaraj. There's been a lot of divergence in the markets, economies, central banks, and even the rates. Because if you look at U.S. economy, from extreme fear of deep slowdown, we are actually seeing numbers coming quite strong, better than expected. Yesterday's GDP number was the latest in the series, and we also had the jobless claims, which came much lower than expected. Although the previous month's number were also revised downwards quite a bit. So U.S. economy doing well as of now, particularly in pockets like employment is doing well, then services is doing well, consumption is holding up. That's why the GDP was better. But on the other hand, if you look at Eurozone economy, we had a series of weak economic data, starting with industrial production, then the retail sales, then IFO from Germany, where the expectation index was far lower than what it was forecast, and then the GDP number for second successive quarter coming negative, which it is technically in a recession. And add to that, we also had the other big economy in the Eurozone, France, also had bad news on the plate. Business climate in France deteriorated in May, falling by 2 points to 100, its lowest level in the last 2 years. And the decline is notable in the services sector, because in most of the other economies, including USA, service sector has been holding up, but France is seeing a fall in the service sector activity. So given these and the early signs of the labor market weakness, a weaker outlook according to business leaders, and persisting high inflation, expected global growth, and the impact of monetary tightening being felt in a meaningful way, we are now expecting actually French GDP growth also to be weaker in the coming quarters. Now, the ECB is expected to raise rates again at its next meeting, and possibly on June 15th as well, as per Klaus, not one of the ECB members. It will only be in September that will make a review, depending on how the data comes. So rate increases to rein in inflation alongside a slowing economy is a clear pathway to stagflationary situation in Europe. As far as US is concerned, apart from the debt issue, the economic data is actually giving a raise to uncertainty over the rate path. What was being earlier seen as a definite pause in June and 3 rate cuts later in the year has now turned to around 40% chances of a hike in June, and possibly about not more than 40 basis points of cut later in the year, as per the market pricing itself. But if you look at the Fed members' speech and all that, they are, in they are concurring with the market views that June may be a time to pass. But again, interestingly, the pass word has been now replaced by the word skip. So skip means a much different thing. That means this month I'm not doing anything, but next month I could do. So that's the way it is being conveyed now. So it's the options are now hike, pause, or skip, and currently June would be a skip, and July is possibly going to be a hike based on the inflation numbers. And of course, Fed has more evidence on the economy today on PCE, core inflation, unemployment data next Friday, and also the next CPI number just before it meets on 13th July for its policy decision. Of course, we cannot take our eyes off the debt ceiling talks, where it seems to be nearing a deal, as per some reports that are emerging now. There's possibly the cap on most of the spending items have been agreed upon, and Biden and Democrats are actually considering scale back or boost on IRS funding as part of the budget deal. It does appear even from the market reaction that it seems to be a reliable outcome that is expected sooner or later. Of course, meanwhile, there has been, amid continued suspense and uncertainty, two rating agencies, Fitch and Morningstar, have put US credit rating on a negative watch. And this is contingent on US missing on its bond payment and being at the risk of default. It does not mean that's going to happen, but they are saying that they are watching the debt ceiling talks. And in these positive news in the Tokyo time today, we have had some improvement in the stock market, of course, following the US market rally as well. And the dollar itself has given back some of its gains, which was seen as a safe haven status. Now, more specifically on the markets, US yields were higher yesterday also, as markets firmed on expectations that Fed is not at a peak, and US yields were across the curve higher, and that 2-year was up by 0.1%. And then the 10-year rate was up by 7 basis points. As I said earlier, June hike is now almost 49% priced in. All the Fed members continue to say that the June can be a skip. As far as the stocks are concerned, lingering absence of a debt ceiling resolution, other yields could not stop a rally in the tech stocks yesterday. In fact, apart from the Nasdaq, S&P 500 was also higher by 0.9%. And the tech stocks benefited from the artificial intelligence optimism, with shares of NVIDIA, which was up 25% after companies' AI-related forecasts surprised even the most optimistic analysis. So it was not the economy or the debt talks, but the corporate news that guided the equity indices higher in European and in US. Of course, European bourses had ended lower, with poor economic data weighing and stagflation fears rising. Japanese stocks resumed their bull trend after 2 days of correction and got further boost after lower than expected Tokyo region inflation today morning. On the dollar, divergent economic news has definitely benefited US dollar more, which is now above the resistance of 103.80, possibly heading towards 105 on a technical basis. This could mostly be due to the weakness in the euro rather than strength of the dollar, because the recession in Germany is probably not fully priced in, and even in UK, high relenting inflation and interest rates headed at least 1% from now, or maximum 1% from now, of from 4.5 to 5.5 will weigh on its growth and make one more economy susceptible for stagflation. Apart from euro and GBP, commodity currencies have lost heavily on fears of major economies slowing down. If we look at the Asian giant currencies, the Chinese yuan has been weak for its own reason. The slowing economy, geopolitical concern, press strain in the relations with the US, and widening differential with US rates has kept it weak and probably headed towards 7.15 on a break of 7.10, and that's about 6.5% weak from the cycle's best level at 6.70 that we had seen not long back ago. As far as yen is concerned, it remained weak due to continued dovish policy of Bank of Japan and the rising yields in the US. However, I see levels above 140.50 offering stiff resistance to the dollar. Now, in fact, Japanese officials have fired their first salvo with the Japanese Finmin saying they are closely watching the forex moves. And these statements, which look innocuous, generally have a big impact. We already had some verbal intervention from Chinese authorities over the last few days, though CNY has further weakened after that. in my view, these official protests will have their impact sooner or later, not because market wants to value their words, not, but it's more on the basis that both the currencies are trading at their most weak levels. So considering the positioning and the level at which it is trading, it can have an impact on getting down the dollar yen sooner or later. And in fact, Japanese authorities may not be too far away from reconsidering their policy approach to the extreme loose policy that they have been following. On the rupee, it has reversed its long-held underperformer status, now trading most stable among major Indian currencies, with exporters and investors taking a positive view based on the evidence of both external and domestic macros improving. Of course, removal of debt deal uncertainty has the potential for USD/INR to fall towards 82.40 in my view. Thank you and have a nice weekend.
Thank you, JK. And just to quickly summarize, of course, as we discussed earlier, US is having some better than expected economic numbers. The country is also doing well in certain pockets like employment, services, and consumption, while Europe is having a string of worsening economic numbers, which is somewhat explanatory of the rise in dollar. It is somewhat also of an uncertain situation for the US central bankers. There is a narrative of rate hike being skipped for the June meeting. This is, of course, different from the pause. PCE numbers due today will give us more clues on the rate path. Debt ceiling negotiations seem to be on a path of resolution as of now, while US yields were higher across all tenors. We are also seeing somewhat of an increasing probability of a hike in June as per the Fed Watch, which tracks the rate probabilities. While on the Asian FX side, Chinese yuan continues to depreciate due to weak economic data and geopolitical tensions, and rupee is trading as the most stable currencies among the emerging market basket as domestic macros remain strong. That's it from us today. Have a very good weekend. Tune in on Monday for latest developments in the financial markets. Thank you so much for listening.